Welcome to LCD's European loan market video overview detailing leveraged finance trends and activity during July 2013. I'm Suchit Gupta, a member of S&P Capital IQ's Leveraged Commentary and Data Team, a unit of McGraw-Hill Financial that is not affiliated with S&P Ratings. For the next few minutes, I'll walk you through a review of recent loan and high-yield bond market trends in Europe before winding up with themes to watch for in July and early August 2013. Before we start, please know you can follow LCD on Twitter, Facebook, and can join the almost 11,000 contacts in LCD's Leveraged Loan Group on LinkedIn, as well as leveragedloan.com and highyieldbond.com, free websites promoting the loan and high-yield bond asset classes. On it, you'll find recent market stats, news and analysis, high-yield and leveraged finance job postings, as well as online primers that explain key market terms. The links to our websites and to follow LCD's social channels are in the info section on our YouTube channel. You can also download the slides for this video at slideshare.net. The European leveraged finance primary and secondary markets were buffeted by volatility. This follows comments made by the Federal Reserve Chairman for eventually tapering off support for quantitative easing. Loan issuance was 7.6 billion euros in June 2013, while high-yield bond issuance was just 2.9 billion euros for the same month. According to JP Morgan High Yield Research, estimated outflows out of European high-yield funds was almost 1.5 billion euros for the month of June versus inflows of 3.8 billion till the end of May 2013. Net inflows till the end of June are still an estimated 1.3 billion euros. Secondary markets were down. Loan markets were down 158 bips to finish the month at 98.3, while high-yield markets were down 359 bips to finish the month at 99.65. The S&P European Leveraged Loan Index, the LE, finished the month down 0.37%. Default rates were also markedly lower for the month of June 2013. Focusing on the secondary loan market, this chart details the average price of LCD's European Flow Name Composite, a measure of the 12 largest, most liquid loans consisting of 10 issuers since 2002. Secondary loan prices fell 158 bips to finish the month at 98.83. This is in line with other secondary markets, be it in equity or credit. This follows comments by the Federal Reserve Chairman for eventually tapering off support for quantitative easing. This is the first time since the beginning of the year 2013 that the loan flow names are below 98. This next chart details the average price of LCD's European high-yield flow name composite, a measure of the 12 most liquid high-yield issues since the beginning of the year 2010. The high-yield market finished the month down 359 bips at 99.65 on the back of a sell-off in the broader credit markets. This is the first time since the end of the year 2012 that bond flow names are below par. Risk is definitely off for now for secondary market investors, though the fall in prices itself should attract value players back in. This chart details the monthly return of the LE, a broad measure of European loan market returns that LCD calculates. All returns are ex-currency unless otherwise stated. With the decline in the secondary markets, the European loan market had a negative return of 0.37 for the month of June, down from the positive 0.11% seen in May 2013. This brings the first half 2000 return to 2.85% versus 4.93% for the same period last year. Now we turn from the secondary to the primary. This graph details new issue volume for both leveraged loans and high-yield bonds. High-yield issuance totaled just 2.9 billion euros in June, the lowest tally of the year, with the AA group the focal point of activity, while two deals were pulled from the market. Conversely, the loan market picked up the pace in an effort to print deals ahead of the summer break, with a monthly volume of 7.6 billion euros. Overall, volumes may have still lagged previous months, but the long-awaited supply surge, 19 loans launched during June, afforded investors the ability to pick and choose for the first time this year. While the market appeared to brush off volatility as DE master blenders netted enough of an oversubscription to enable a 25 bips margin reductions, investors were cautious about funding more esoteric and highly leveraged deals. The default rate by principal amount was down to 5.3% at the end of June from 5.8% at the end of May, while the default rate by issuer count fell to 6.6% at the end of June from 7.2% at the end of May. Themes to watch for going forward. Given the current volatility, the market will have to recalibrate itself to find new appropriate levels of risk. Pricing and yields will widen, while documentation will veer towards investors rather than issuers. The CLO calendar is still strong. However, there's still quite a lot of unease over EBA directives and politicians' attitudes towards CLOs. Issuers are looking towards the U.S. market for liquidity and best execution, be that either through loans or bonds. That brings us to the end of our overview. I hope you found it informative. We'll update the analysis each month and plan to have analysis of other specific European market segments going forward. Check out LCD's YouTube page for other video analysis of the leveraged finance market, including U.S. loan market wrap-ups. The link to this page is in the description for this video. For more information on LCD news or research in Europe, you can contact Anna Cini. You can email her by clicking on the link in the info box. Thanks very much. We'll see you soon.